Thank you, Kevin, and good morning, everyone. Always nice to be back in London. Always nice to kick off the year with Marine Money here on Park Lane. So the title of my presentation today is The Next Chapter, Finding the Direction Through the Shipping Cycle. And over the course of the next 20 minutes or so, I hope to give you a flavour of how we are seeing the markets develop at MSI, some of the sort of nuances that we're starting to observe, and of course how we expect things to develop over the course of the next few years. As I am here at the start of the year, I thought I would just do a headline market view and sort of pick out some of the sort of overarching themes and where we're at within the shipping markets. 2 years ago, I was stood here at Marine Money talking about black swans, as was a lot of the panels and the presenters. And as we've heard today, we've literally moved from black swans across to geopolitics, as we can see on my Google Trends analysis, which isn't particularly scientific, but we can certainly see that what people are talking about. And of course, geopolitics are creating both headwinds, tailwinds, and crosswinds for shipping, and we'll hear about more in the presentation. And of course, we'll hear more about that over the course of the day. The other thing I would say is that what I'm calling is we're in the great pause. We're in the pause of regulations, rules, and events. And although these have been quite good for shipping, I would suggest over the course of the last 12 months, they're still languishing in the background and they could pop up at any time soon. USTRs, Chinese port fees, net zero framework, Red Sea rerouting. I think, of course, these things being on pause has been good for shipping. The one thing I would say is it does introduce yet more uncertainty. And uncertainty sometimes is a good thing, but I think if you're investing in shipping, uncertainty is probably not what you want. You probably want something a bit more rounded, a bit more with a bit more foundation if you're actually going to sort of put money on the markets. So where have the markets and how have they performed over the course of 2025? Well, I've put up here the sort of year-on-year change for the one-year TC rate, new building prices, and second-hand asset values. And as you can see, generally, the market performed quite well from a one-year TC rate perspective over the course of last year. This was somewhat helped by the fact that the start of last year was relatively weak, but we have seen an improvement if we look year-on-year. New building prices, as we said they would, have softened just a little bit over the course of 2025. And second-hand asset values, it really depends on the sector that you're looking at. Containers, dry bulk, we've seen a slight improvement. Crude carriers too, but for many sectors, shipping, we've also seen a softening in asset values. So where are we on the earnings cycle? The infographic. Basically, you'll find a lot of sectors we think are on the left-hand side of the current earnings cycle. That fundamentally means over the course of the next 12, 18, 24 months, we do expect to see a softening in the one-year TC rate. I ought to say that volatility will still feature on this downward trend, so we will see some short upward term momentum across all of these asset classes. LNG has now passed the bottom of the market cycle and will continue to improve, but probably quite slow for the next 24 months. And then we move across to the oil tanker markets. We expect them to continue to perform well during 2026. We've got containers that stubbornly is sitting at the top of the market cycle for the last couple of years. And then we've got offshore. Now you'll find that we've got some offshore on the left and some offshore at the right. And the reason is behind that is that fundamentally it's very much dependent on the asset class you're looking at and also the region that these assets are trading in. We're seeing very different things in Southeast Asia than we are in the Middle East, than we are in Latin America. So it's really much where you're looking at and what you're looking at will dictate how you view the offshore market currently. Earnings, as I say, have been strong. And what I've done here is just run some IRRs from 2008 and assumed that we bought a vessel, we kept it for 5 years and what the IRR returns would look like. And we can see if you bought a vessel in 2020, on average, you have got returns of above 25% within shipping. And that has been some of the strongest markets that we have seen since the boom that we saw between 2002 and 2008. And that strength in the market has caused some people, some commentators in the market, to start comparing where we are now to where we were in that sort of super boom era. So I just thought I would compare some sort of headline metrics just to see what the market looks like today versus the market then. And I would say that generally we're not sort of in the same environment as we saw back in that 2002 to 2008 period. That was, today you can see some comparisons between the fleet perhaps in terms of the order book, but we saw a very sort of different set of demand side drivers back then. And of course what we're seeing today is sort of okay demand, and we'll come on to that, but we're also seeing a lot more inefficiencies within the shipping market, which is also fueling the strength that we've seen in earnings. That leads me nicely on just to talk a little bit more about the cargo side. And generally from a cargo perspective, our outlook is relatively positive. Certainly if we look at the gas carriers here, LNG, LPG, we can see some very strong growth rates as we move forward to the back end of this decade. Container ships too, in aggregate, will grow, continue to grow strongly over the course of the next few years. I think the crude and the oil tanker markets, we will see strong growth currently, but perhaps by the sort of back end of this decade, we will start to see some softening. That all being said, our view of cargo growth, if we look at the chart on the right, our view of cargo growth is actually stronger for many sectors for the next few years than it has been for the last few years. So realistically, we are sort of in a stable but strengthening cargo growth environment. To focus on the sort of the main three shipping sectors, and I've just got a slide on each, and just going to start off with dry bulk. The top left-hand chart just gives me an opportunity to talk about China, and you can't talk about the dry bulk markets without mentioning China in some shape or form. The chart here is just showing Chinese steel dynamics. I'm just trying to work out what I call the chart. Chinese steel dynamics. And basically what we're seeing in the Chinese economy has been relatively resilient. But the resilience hasn't been generated typically by areas of the economy that have been supported for shipping. So this chart here just shows us how Chinese steel production has developed over time. We can see that actual production has started to trend down, but I guess what is more worrying is that steel consumption number has trended down at a quicker pace. And we can see that net export gap has opened up. So that is, of course, good for steel exports, but it's not so good potentially for iron ore and coal imports. It's not all doom and gloom in the dry bulk market. One of the bright spots last year was the level of exports out of Guinea of bauxite, 22% up last year, and that came off the back of a very strong 2024, as we can see on the chart on the bottom left. So if we're looking at the dry bulk market where incremental demand, incremental cargo will come from over the course of the next few years, there will be, we think, a little bit of a drag from coal cargoes as we see this sort of evolution and the development in the energy landscape and the moving towards cleaner fuels. Minor bulks, grains, bauxite and iron ore, certainly out of Samandu, will also help prop up the dry bulk market over the next few years. From an oil tanker market, it really is the case that we've seen a real rapid increase in oil production. And that is fundamentally one of the reasons that we've seen such strength in the VLCC market over the course of the last few months. We can see how OPEC has sort of ratcheted up their production quotas in the chart on the left pretty much month on month. We are now seeing a lot more oil on the water. A lot of this oil is coming out of the Middle East, is going on distances to places like China. But of course, the relative winners and losers in the oil tanker market, whether it be product or crude, is very much dependent on where the refineries are located. And we're still in this narrative whereby the refineries are becoming closer to the wellheads, which is obviously not so good from the crude tanker market, but is great from the product tanker perspective. And that sort of is one of the reasons we've seen so many LR2 vessels being ordered over the course of the last couple of years, because of course everybody knows that the longer distances, it makes more sense from an economies of scale perspective to use the larger product tankers. So we can see the dynamics playing out on the incremental oil trade. A couple of good years for crude, but then it reverses and we're a bit more positive, a lot more positive on the product side. From a container perspective, I think the container industry is the industry that's probably been buffeted around most by tariffs over the course of the last 12 months. And one of the artifacts of that is, if we look at the chart on the top left, and one of the trades that suffered most has been the Asian exports to the US. We can see the red line over the course of the last 6 months. That's tailed off quite significantly. At the same time, if we look at the shares of the exports by Asian economies, we can see China's exports to the US have continued to decline. Some of these volumes have been replaced by ASEAN nations, but generally there has been a decline on this trade. Now, that's not to say that China has been not finding new homes for its products and its manufactured goods, and one of the homes that it has found has been Africa. We've seen huge volume increases from China to Africa, as we can see on the chart on the bottom left. And perhaps it's no coincidence that the biggest increase in volumes has been going to Guinea, where, of course, we have a lot of the new mining expansions and increasingly a migrant Chinese population that is also moving to help service, whether it be bauxite or the iron ore mines, the new ones in West Africa. Now, this is just a cautionary slide, and one that I've been monitoring across what we do at MSI. And what I've been noticing is that we're now seeing a continued build-up in stockpiles in China. And what we can see here are 3 dry bulk commodities and crude oil. And you can see over the course of 2025, in some instances, we've seen some significant volume increases in stockpiling in China. This is obviously been good for shipping over the course of the last 12, 24 months or so, because it's we're not just relying on consumption of commodities, we're building up what I call false demand from stockpiling. The cautionary note, of course, is if these stockpiles get drawn down, we're not going to need shipping to service that incremental consumption. So it's just a cautionary note that I thought I would throw out there. Now, the cargo growth tells us part of the story, but it's really important to translate that view of cargo growth into what does that mean for vessel demand. And of course, and we've spoken about it already today, the rerouting of vessels via the Suez Canal via the Cape of Good Hope has been a huge draw on tonnage. And it means that the fleet has become less and less efficient. We think around 1.8 million TEU of container ships is being utilised just going around the Cape of Good Hope. So the moment we start moving all containers back through the Suez Canal, there's a lot of tonnage that we need to find a new home for. And if we look at the numbers, we can see that actually we have started to see some vessels go through the Suez Canal. We've seen, actually over the course of 2025, we saw nearly a 20% increase in vessels going through the Suez Canal. I think in the advent of the ceasefire and people getting a bit more comfortable with sending vessels through the Red Sea. And interestingly enough, we've also seen an uptick in the number of vessels going through the Panama Canal. We're not quite back at the levels that we saw pre-drought in Central America in 2023, but we're certainly moving in the right direction. And all of this means that the fleet is becoming a little bit more efficient. But one of the things that we can certainly measure, and we certainly can spend a bit of time looking at, is the sort of ton-mile impact. And when you look at the ton-mile impact for the crude tanker sector, we can easily see why we've seen such strength in this market over the course of the second half of last year. We can see from the chart on the left just the year-on-year increase in volumes or distances in terms of crude moving from intra-basin, that is from China to from the Middle East to China, for example, or from Latin America to Asia. Those are long distance, and we're not really seeing the growth in those shorter intra-regional trades. So that's been very supportive of the tanker market, and the same for the container ship market. We continue to see increasing long-haul trades over the course of the last few years. On the dry bulk side, we've done a bit more digging utilising our Seascape platform, and here we can see other inefficiencies within the dry bulk market. We can see that voyage times for dry bulk were longer last year. That was both an extension of ton miles, but also vessels slowed down by around half a knot last year, which means, again, inefficiency. And an interesting one that we were able to pick out is that vessels are spending longer in shipyards. I think this is partly an artifact that the fleet is getting older, but also more and more vessels are having retrofits and energy-saving technologies fitted on board, which obviously take a little bit longer and more time in shipyards. So really, to understand the cargo side and how that feeds into the supply and demand fundamentals, you really need to make sure you pick the right variable. And I've just put these two charts up to sort of showcase that. If we just pick one sector and 1 year, so if we look at 2024 for the oil tanker, we can see that cargo growth was less than 0.5% in 2024. From a ton-mile basis, it grew by 3.5%, but if we translate that into shipping demand, it grew by 4%. So that sort of emphasises just exactly why we need to be careful when we're looking at cargo versus actual shipping demand. So moving across onto the other side of the equation, the supply side, contracting over the course of the last 5 years has been strong. As we can see on the chart on the left, containers has represented a large share of contracts throughout this 5-year period. Around 45% of all tonnage ordered last year was in the container ship sector. And as we can see on the chart on the right, China continues to dominate in terms of taking those orders. There has been a slight move away from China, I would suggest. In 2024, around 75% of all orders ended up at Chinese yards. Last year, it was more like 65%. So there could be this shift away from China from a geopolitical, from a USTR perspective, but China still remains very dominant. Another trend that we've also noticed is this move towards larger ships. We can clearly see that for both the dry bulk and the tanker sector. We've seen a move. More than 50% of all vessels last year were Capesize. More than 50% of all vessels were VLCCs ordered last year in those two markets. The containers have always been ordering big ships. I guess the interesting thing from the containers chart is that we're starting to see more smaller vessels being ordered, something that the industry has been asking for quite some time. With all of these orders, it does mean that the shipyards are relatively full. As we can see from the chart on the left, we can see that if you were to place an order today, your best bet is that you're going to get it probably the second half of 2028, more likely 2029. But what is interesting, it really is China that has capitalized on this current ordering glut. If we look at the chart on the right, which just shows you the order book at the end of 2023, the end of 2024, and the end of 2025, we can see for Korea and Japan, the order book hasn't really budged. Whereas in China, that order book has gone up significantly, which has been helped by the expansion of existing shipyard capacity and new capacity coming on stream. Now, the order book, rightly so, does get a lot of column inches and a lot of people talking about it, market commentators, and I say rightly so. We can see here, there's a little bit lot going on this chart, but what we're trying to show on the x-axis is the order book as a percentage of the fleet, and on the y-axis is the order book as a multiple of those vessels over 20 years old. And why this is important is if we look at the Panamax, the yellow circle there, Panamax, we can see the order book is around 20% of the fleet, but the order book is 6 times bigger than the old fleet. What this means is if we see a softening in the market, the industry can't scrap its way out of a problem. Now, although the order book is large, it's the third largest order book ever, over 300 million gross tons, I would say that we do need quite a lot of ordering for some select sectors. We can see the zoomed in box in the top right. We can see small containers, small dry bulk carriers, small LPG. They've been very little investment in these asset types in terms of new orders over the course of the last few years. But we do think that the fleet will grow, and will grow quite a lot over the course of the next 2 or 3 years, as we can see on the chart on the left. You'll also see on the chart on the left our aggregated view of scrapping, and we're forecasting some significant scrapping numbers as we approach 2030, around 60 million GT. Now that does seem like a very big number. The one thing I would say to this is that if we look at the fleet as a whole, and we factor in our view of contracting, deliveries, scrapping, and we look at the age profile, how that will evolve over the next few years, by 2030, even with all of those scrapping volumes, the average age of the fleet will be over 15 years old. Over 50% of the fleet will be over 15 years old. So we are coming into an old fleet environment. So now, just to try and bring things together and look a little bit about the earnings and asset values. From an earnings perspective, this year will remain relatively robust, but we do think next year we will start to see a bit more softening in a lot of earnings, the one-year TC rate. As we can see from the orange bar, the one thing I would say from the orange bar, please do compare it to the blue bars, which is the average from the 2010s and the average from 2020 to 2025. The orange bar in many instances sits at or above those historical averages. New building prices, we do think will continue to soften. The rationale behind this is that if we see more deliveries and new contracts, the only things that the yards can do to try and bolster their order books is to drop prices to try and attract new orders. Again, if we look at our actual forecast on the right-hand chart, which shows you how low we think new building prices will go as we move forward over the next few years. Even when we sort of hit the bottom of our new building price in 2028 and 2029, it remains at levels around what we saw in 2022. And if you look at what the market was saying about new building prices in 2022, the market was saying that they were quite high then. It's more that we've gone into this sort of super high territory. We're just going to be coming back to more normalized levels. Second-hand asset prices remain incredibly sticky. We're not seeing a huge amount of movement in asset prices alongside movements in the one-year TC rate, as we can see in these charts, which just show you sort of the annual evolution of asset prices for a range of asset sectors. Even for LNG, of course, we saw the lowest one-year TC rate for LNG last year. And if we look at what went on in the LNG asset prices, they didn't budge a jot over the whole of last year. So we're not seeing that flexibility, that sort of tight correlation between earnings and asset values currently. But with falling new building prices, with softening earnings, we do think asset prices will eventually come off. For anyone that's not seen a chart like this is just a simple box and whisker plot. The box and whisker plot just show you the historical distribution of a variable over time. And what I've done here is plot second-hand values since the 1990s. The whiskers show you the maximum min. The box shows you the 25th to 75th centile. The horizontal line in the box shows you the median. And what I've done to that historical distribution is I've plotted where second-hand prices are today, that's the red circle, and where we think second-hand prices will be by 2028. Now, yes, the green circle is below the red, but again, please do compare it to historical averages. You can see that pretty much in every instance, the green circle is above the historical median, and in many instances, the green circle is at or above that 75 centile level. So prices will soften, but in historical context, they'll remain high. And finally, as I always like to do, is sort of run all the numbers through the MSI system and just try and work out where are the current best investments for shipping. And this time, given that we do see a market softening over the next couple of years, and given we know that timing is everything in shipping and having a long runway can sort of generate returns, what I've done here is assume that we buy a 10-year-old today, and we either sell it in 2028, We either sell it in 2030 or we sell it in 2032. And I guess the message from this slide is, if you're going to buy tonnage today at today's prices, you're probably best holding it for at least 5 years rather than looking to get a quick return. So that's everything I had to say. Again, a lot of information to take in, but hopefully there was something there for everyone. Thank you.